So everybody is here for venture financing? Okay, I guess this is the advanced class, whatever that means. Let's get started. So I have a whole bunch of really boring slides, and I'm happy to share them with you later on if you don't want to take notes or whatnot. And there's a lot of information in there. It's probably too much. So I don't intend to cover everything. I'd much rather just answer questions and chat with all of you. So let me just get started real quick. My name's Jeff Char. I'm originally from Hawaii. I'm born and raised there. I spent 10 years in Silicon Valley and 23 years in Japan. So lived half my life in Japan now. And I'm currently based in Tokyo. So the reason why I'm telling this to you is so that you can understand some of my comments and where I'm coming from. But I started my career off in securities as a research analyst covering Japanese equities in Tokyo. I worked for several years as a corporate finance lawyer, so that's why my slides are so boring. And for the last 15 years, I've been a serial entrepreneur, starting companies. Started in Silicon Valley, built 3 companies, sold them, and then I moved back to Japan. And every now and then, I have other people's money that I invest in other people's companies, which is my definition of venture capital. And more often than not, I invest some of my own money in early-stage startups, and that's my angel investment kind of fun and games. So I run a company called J-Seed Ventures. I started this company in Japan in 2000, and this is after building and selling 3 companies in Silicon Valley. And when we moved back to Japan, my wife told me I wasn't allowed to start any more companies. So that's why I created J-Seed Ventures. And this is the lawyer in me. So it's a big loophole because the business of J-Seed Ventures is to start other companies. So I told her, yeah, honey, this is my last company, don't worry. And, but my job is to start new companies. So we've got 9 companies, I guess, now. We typically start them, build them up, and then sell them. And we do 2 things. We either start companies that have some innovative business model or some innovative technology, preferably both. I like to do different things, new things, and I don't like to do what everyone else is doing. These are the companies that I've started since 1997. And before we begin, I just wanted to give you some advice on fundraising. Since this is about venture capital, the first thing I wanted to say was, I guess, let's see, how many of you have read Lean Startup? All right, most of you? Okay. So with Lean Startup, you try all kinds of different things, throw it against the wall, see what sticks, and you learn from your mistakes, right? With your capital structure, you don't want to do that. So the first thing I'll say is, don't fuck up your capital structure. It's very painful if you screw this up. So from the get-go, you should have a good understanding of finance and how to set up your company from a financial viewpoint. Also, I would recommend against raising too much money too early on. I think I talked with some of you today, and I made that suggestion. You know, when you read TechCrunch or Tech in Asia or all these different publications online, they always write these stories about, you know, X company raises $10 million or whatnot, and it sounds really sexy. But what it really means is that company now has people telling them what to do. And typically, they raise the money with a story about how they're going to go really quickly and grow up, and they're going to charge after this new area of business, and this is how they're going to do it. And what happens is, when you raise money on a story like that, you get locked in. And the investors who gave you that money expect you to carry out that story. But oftentimes, the market teaches you that that's not the best way to go, and that you should change how you're doing that. And it's really difficult to change and do it differently after you just told this big story to investors and raised a whole bunch of money. So I strongly suggest that you don't raise money from other people. That's what OPM is, other people's money. that you don't raise money from investors until after you've figured out what you're doing, you've proven the business model, and now you want to scale it up. And to me, that's the best time to raise money, and that's why we're talking about this topic today. But if you're not at that stage, I strongly recommend against raising money. I think it's much better for you to be broke, poor, and creative. If you don't have money, especially other people's money, and you only have your own money, you're going to use it much more wisely. And you're going to be much more creative in coming up with solutions. And that's what leads to your competitive advantage down the road. So don't skip that phase. That's a really important phase. Don't just run out there and raise a lot of money because everybody else is. That's a dumb strategy. Valuations, we're going to talk about technical stuff today. So I just wanted to point out in the beginning, raising money at a high valuation seems to be the right thing to do, but it's not always the right thing to do. There are some situations where even if you could get a higher valuation, it would be against your best interest to do so. And that's because if you know deep down inside that your company is not anywhere near that valuation, but you raise it at a super high inflated rate, that may come back and haunt you later on. Because it may mean that the next round of financing you do, and there usually is a next round, you're going to have to do a down round. You're going to have to raise money at a lower valuation. And that really sucks. I can't tell you how bad that is. Your investors will not be happy. And then the last thing is just, if you're doing this, again, I worked in Silicon Valley and I worked in Tokyo, but you don't want to hire a lawyer who doesn't know what they're doing. I don't care if they are cheaper by the hour. Ultimately, it'll prove to be a lot more expensive. So you want to get somebody who's done this before, who can really teach you, and who has your best interests at heart. Okay, sorry for the long intro. So let's get started. First thing is common stock versus preferred stock. And again, I've only worked in Silicon Valley and in Japan, so my opinions are all totally biased, and I don't know how things are done in Malaysia. So I'll preface that. Having said that, typically for venture capital deals, we use preferred stock. And the reason is, or let me go back. There's a fundamental difference between preferred stock and common stock. Common stock is typically defined by the corporate law, or whatever law that covers corporations in your country. And the rights and privileges of common stock is usually set out in the law. So in other words, you can probably point at some section under the law and go to the books and point out, it tells you what common stock is. Preferred stock, on the other hand, is made up. It's usually done by contract. It's usually negotiated. And then once you reach an agreement on what it is, you write it into the Articles of Incorporation. So the parties can make this up to a large degree. And typically, preferred stock is more expensive than common stock. So this is the whole model of venture capital was created so that the founders can buy stock in their company at a cheap price, and then investors later on come in and buy stock at a much more inflated, expensive price. And one reason for justifying that higher price was by dividing the stock up and saying, you're getting this special, super preferred stock that has all these extra rights and privileges, and that's why you're going to pay a lot more than the common stock. And typically, in Silicon Valley, for example, with startup companies, this is a really important distinction. This distinction of time and the difference between preferred and common stock to justify the huge difference in price. Oftentimes, the price will be 10 times higher. And this is just a kind of a rule of thumb, and it's typically for pricing options. So if you're raising money at, say, $10 a share, you may turn around at the same time and issue options to buy common stock to your employees for $1 a share. And the difference that you're trying to justify to the tax authorities of why this is because the preferred has special rights. And obviously, it's because you want to attract good employees, and you need to incentivize them, and you don't have any real money, so you use this kind of monopoly, fake money, to attract them. Again, 10 to 1 is kind of a rough, unspoken guideline. But in terms of negotiating to sell preferred stock, of course, you're trying to get the best valuation and negotiate a high price. So this is my agenda for today. Again, I apologize. It's ultra boring because I'm a lawyer. But I kind of view preferred stock financing in this way. So I've divided it into 3 areas: preferred stock rights, restrictions, and then contractual rights. And again, I'll make this open to anybody who wants a copy. So let's start off with preferred stock rights. Probably the 2 main things to talk about today for preferred stock rights. One is going to be this right here, liquidation preference, and the other one is anti-dilution. Again, this can get really technical and really boring very quickly. So I'm just going to do a real high level on this. In terms of liquidation preferences, the reason why this is important to you is because it actually makes a huge difference in how you run your company and when you exit. If you build a company and let's say you go out and raise money, and when you raise money, usually what you talk about is a pre-money valuation. How many people here do not know what pre-money valuation means? Okay. So to make it really simple, if I'm going to, let's say I started a company today, and I build it up, and I need to raise money, okay? When I go and talk to investors, they always ask me, what's the pre-money valuation? And what that means is, if let's say I'm trying to raise $1 million, okay? And if I say I'm willing to give 20% of my company to raise $1 million, what's my pre-money valuation? So my pre-money valuation would be actually $4 million, right? Because I'm going to issue 20% new shares to raise $1 million. That means at the end, my post-money valuation would be $5 million, right? 20%, $1 million. So my pre-money valuation would be what happens just before that. So it's $4 million, okay? So when you talk to investors, make sure you always talk about pre-money valuation. If you talk about post-money or other things, they know you're an amateur. Okay, so we always talk about pre-money valuation. So in this case, if I want to raise $1 million and I'm willing to sell 20% of my company to do that, my pre-money valuation is going to be $4 million. Okay? The problem is, let's say, before I do this, I think my company's worth $4 million. But do I have $4 million today? Probably not, right? Probably I've got $10 in the bank and big dreams, but I have like almost no cash. So that's most likely the case for many of you here, and it's usually the case for me. So my pre-money valuation is really just a phantom valuation. It just means what I think the company's worth today before I raise money. And it's really more a function of how much do I want to raise and how much am I willing to give away. So the pre-money valuation is really just made up. It's a fiction. Okay? So the reason why liquidation preference is important is because let's say 1 year from now, so I raise $1 million, I give up 20% of my company. Okay? 1 year from now, if somebody approaches me and offers to buy my company for $5 million, okay? The investor who put in $1 million is basically just going to break even, right? If they bought common stock, they would have 20% of the company. And if we sold the company for $5 million, they'd get $1 million. So the only thing was they'd just get their money back, okay? Not too happy about that, right? I, on the other hand, would have $4 million. I'd be kind of happy, right? Not bad. Better than a poke in the eye. So liquidation preference means, what does the investor get before I get my money? So in other words, the preferred investor, typically they negotiate liquidation preference, which means they get to stand in line first to get their money. And there's all kinds of ways that they can set this up, and it's negotiated. But the main reason why this is important is because, go back to the earlier example, okay? We raised $1 million, we gave up 20% of the company. What happens if I sell the company tomorrow for $4 million? Right? The investor actually loses money, and I get a windfall. Right? Or let's say we sell it for $1 million the next day. Right? I get to raid the cash. I get 80% of the cash, even though I didn't have any money. So as far as the investor is concerned, they want to make sure that they get their money back first before I get rich. Right? And preferably, they would get their money back plus something else. So we can go into this in more detail if you want, but basically it's just a mechanism that's totally negotiated that decides how much money they get first before I get to see any money. Okay? So remember this, a lot of the legal terms that we use, a lot of the technical terms, liquidation preference, anti-dilution, these are all bullshit terms. You just understand the concepts behind them. That's way more important. There are many different flavors of liquidation preference, and I could put you to sleep telling all the details about them. But really the important thing is, when the investor stands in line first. Okay, that's all it is. They get to stand in line first, they get to get paid first. And the only question is, how much more do they get paid? Okay? And there's all kinds of tricks on this. They can get paid first, they can get paid twice. So they could get paid once first, and then they could actually, whatever's left over, then they could actually take their percentage of that as well. That's called participating preferred. Sometimes there's a cap on it, 3 times, 5 times. So they get 5 times their money back first, and then you get money. And why this makes a difference really is very important when it comes time to sell the company. Okay? So if the company goes public, typically this doesn't matter because the preferred all converts over to common at an IPO. But if you want to sell your company before that, an M&A, a lot of times an offer from a potential buyer is attractive to the founders, but not attractive to the investors. And the reason is that for the investors, they may have negotiated really strong liquidation preferences where they get paid 5 times first. So, for example, if the investor put in $1 million and I'm going to sell my company for anything less than $5 million, they may take all the money. Right? The preferred investor might take everything. On the other hand, if I sell my company for $100 million, then they'll probably convert and everybody gets rich. Right? I have a slide here that will definitely put you to sleep. So I tried to come up with a table here that was easier to understand so that I didn't have to stand here and tell you all the different examples. Again, you guys can have a copy of this and you can work through it on your own, but the basic idea here is that if there's no liquidation preference and it's just converted over to common, what would they get? And that means we all stand in line at the same time and we get a pro rata. We get the same percentage. Versus if they have a liquidation preference, but they only get their money back first. Versus they get 3 times their money back first. Right? Versus they get all their money back and they get to participate. So I put down 4 examples here. And probably this is where you can see the difference in these areas. So, for example, if the company got bought for $5 million, what happens? Versus if it gets bought for $20 million, what happens? And this is where you start to see some difference. So, as you can see, the higher the price, the more attractive the acquisition or the purchase price, the more likely you're just going to have them convert over to common and everybody kind of goes home with a lot of money. But the lower the price, they're probably going to say, hey, I'm going to use my preferred rights here and I'm going to take the money first. And the founders may end up with nothing. So again, it really depends on the circumstances. If you've built a company and you sell it in the first year, the founders could be very happy. But if this is year 7 and you're getting a very low offer, it could suck. It could be a really bad deal for you as a founder because maybe your investors get paid off, but you end up with nothing after 7 years of hard work. And so a lot of times when you see these so-called acqui-hire purchases in Silicon Valley these days, where a team is being bought for an HR acquisition, it's a low price. The investors get some of their money back, but oftentimes the structure of the acquisition will be that it's a low purchase price, but there are big signing bonuses for the employees that come over, and that's in order to keep them. And this really changes things. So how you negotiate your liquidation preference is very, very important. It's probably one of the most important things you do in negotiating a preferred stock deal. And again, there are so many details on this that you definitely will fall asleep if I tell all of them to you today. But this is where it makes sense to get a good lawyer that can walk you through this. Yeah? And it's negotiated. It's all negotiated. So the next really boring topic is anti-dilution. The best way I can say for this is it's trying to be fair. Okay? And sometimes, because the investors, realize this one thing. If you're an entrepreneur, even if you're a serial entrepreneur, you may negotiate venture financings a few times in your career. But if you're a venture capitalist, you do this every day. Okay? So it's kind of like you're negotiating against somebody who's doing this. This is their job. And it's only one task for you that you may or may not do again in your life. So understand they have the advantage. Okay? On the other hand, remember that all of this is negotiated and you're trying to come up with a solution that's win-win for both of you. Okay? So the only thing I can say is just don't be stupid. Do your homework before you go in there. Don't try to out-negotiate them. Again, venture capitalists, this is their job. But keep up with them. Don't think that you have to dominate it or that you have to win. But be educated and keep up with them. And a lot of times, I've seen some entrepreneurs really negotiate a bad deal because they felt like they had to show that they're in control. If you're not sure, just say, okay, I understand, let me think this over and I'll get back to you. And then you can go back and you can think it over and you can talk to other people who know a lot more than you do and they can educate you on it and you can make a reasonable, educated decision and get back to the venture capitalists. There's nothing that says you have to make a deal on the spot. So don't try to be, super CEO and negotiate on the spot and say, okay, yes, no, yes, yes, because you'll probably end up with a bad deal. So anti-dilution, basically what this means is a really simple example, stock options. Okay? If your company is going to issue a lot of stock options to employees, then what happens is the existing investors get diluted. Okay? So if you have, let's say, 80 shares, just to keep the math simple. If you have 80 shares and you're going to give 20 shares to a couple of new employees, that means that the people who have the 80 shares are all going to get diluted by 20%, right? So whoever had 8 shares or 80 shares before is going to end up with 80% of the company instead of 100% of the company. Okay? Very, very simple stuff. And the only thing that anti-dilution is trying to do is to make sure that whoever has a certain percentage, that they're able to maintain that over time. Let me switch stories here a little bit. Most of us who go to school, if we study about finance or economics or whatnot, you learn portfolio theory. So, you should diversify your portfolio. You should buy lots of different things and diversify risk. Okay? Venture capital works the total opposite of that. Venture capital, typically, a venture capital fund will make money from 1 or 2 investments in the portfolio. Okay? So if you're a portfolio manager, let's say you run a mutual fund, you want to invest in a lot of different things and have small percentages in all of this and kind of balance out your risk. And at the end of the day, you end up with, I don't know, 6, 8, 10% returns. And that's a good job. But with venture capital, typically, if you invest in, say, I don't know, 30 companies, 28 of them could be total dogs. You lose everything. Okay? One of them might be okay, so-so, and one might be a home run that returns the entire value of your portfolio. Okay? So the dynamics are very different. And what that means is a venture capitalist, when they invest in a company that's doing well, they want to invest more money in the next round, and even more money after that. So at a minimum, they want to maintain their percentage. So if they came in on the very first round of the Series A, for example, and they own 10% of the company, and the company goes on to raise more money in a Series B, and more money in a Series C, more money in a Series D round, they want to maintain their percentage. So every time they want to be putting more money into that one deal because it looks like a really good deal. So for them, what they don't want to have happen is that they put they bought 10% of the company in the Series A, and then in the Series B, other people invest and they don't get to invest and maintain their percentage. For them, that would be a disaster. So that's why they want to negotiate this anti-dilution provision. They want to maintain or to expand in companies that they think are doing well. And remember, this is a one-way street, typically, in the sense that the investors have this right, but not an obligation, to maintain that percentage. That means if they don't like your company or they're not sure that you're doing well, they don't have to invest. There's no pressure for them to invest. But if they think you're doing well, they want to pile in. They want to actually own a bigger chunk of the company. Because, again, if your company is one of those breakout successes, you're going to return the entire value of their portfolio to them. And that's a dynamic that's unique to venture capital. So anti-dilution provision is really important for them. They will negotiate this very aggressively. There are 3, broadly kind of dividing it into 3 categories. There are 3 types of anti-dilution. I won't go into all of them, but the most draconian, the worst one for an entrepreneur would be called full ratchet. There's narrow base and there's broad base. Broad base is kind of, I guess, the most fair, so to speak. And again, since I'm an entrepreneur, I really care about these things. If I have to negotiate anti-dilution, and this is almost always a given, I want to shoot for a broad-based anti-dilution provision. Narrow-based means, and I'll give you the formulas are in here for how to do this, but let's see if I really put you to sleep. Here, you can look at this. Have you fallen asleep yet? So this is like the formula for anti-dilution. And there's way too many letters in there. They're not even numbers. Basically, the idea is if it's a broad-based dilution, anti-dilution, it means it's including all of the investors and all the options in there to divide to come up with a denominator. So the adjustment is smaller, okay? With a full ratchet, the denominator is only the investor. And so the percentage change, the adjustment is much bigger. And what happens practically is that the entrepreneurs, right? If you're somebody who owns 0.1% and you get cut in half, that's 0.05, big deal. But if you're a founder of the company and you own 60% and you get cut in half, 60 goes to 30. Huge difference in dynamics, right? You lose control of your company. You could lose control of being able to dictate the direction of the company in managing where you're going. So it's really, really important. This is one of the key things. anti-dilution. And again, I don't really look at anti-dilution from the mathematical viewpoint. I look at it from the entrepreneurial viewpoint, which is, this is going to cause me to lose control of my company, and I don't want that to happen. So I negotiate anti-dilution very aggressively. I'm willing to take a lower valuation, if I have to, in order to not have a huge anti-dilution clause. Okay? So again, a lot of entrepreneurs, as I mentioned earlier, negotiate for the highest valuation. To me, that's only one of the factors. Valuation, a high valuation is good, but it's only one factor. So if I have to trade and take a slightly lower valuation, but I get much more modest, much more reasonable anti-dilution and liquidation preference, I'll go with the lower valuation. Okay. If everything goes well, and your company is always going up and to the right, great. Then you don't have to worry about any of these provisions. But my experience is that shit happens, and it happens often. And so I want to make sure that I limit the downside risk, and that I'm actually able to have enough time and enough control to take my company to success, to where I want it to go. And in order to do that, I'm willing to trade the valuation for more stability. And so I would recommend that you take a look at those two key factors, the liquidation preference and anti-dilution. And even to the point of negotiating a lower valuation in order to get a better balance on these other two factors. Okay. I've looked at a lot of books and about the subject of venture financing. Oftentimes, those books are written by academics or by the VCs. And rarely are they written by the entrepreneurs. So that's why I'm throwing in my 2 cents here, in that I'm really adamant about this. I think it is much more important to come up with a reasonable valuation, but being able to maintain control of the company and come up with a solution that works for everybody. Going back, this is an example. If there are 1 million shares of common stock outstanding, and the original purchase price was 10 cents per share, that means that the founders put in $100,000, say, to start the company. And in order to bring on more employees in the future, we have an option pool for 100,000 options, options for 100,000 shares at 10 cents a share. And again, notice the difference in pricing here between the common and the options and the preferred, 10 to 1. Again, there's no hard and fast rule about this. It's just kind of benchmarking. But you do the first round, the Series A, at $1 a share, and you raise $1.1 million. You raise $500,000. The pre-money valuation is $1.1 million. Okay, and again, don't try to, I just made this up. So let's say that before I raise financing, I go out and I tell the investors, potential investors, I think my company's worth $1.1 million. And I'm trying to raise $500,000 in cash. Okay? So that means that if I'm successful in raising my Series A round here, I raise $500,000, right? Selling 500,000 shares for $1 a share, and I get $500,000. So my post-money valuation is going to be that plus the pre-money valuation, so $1.6 million. Okay, and then we grow the company more, and I go out and I raise $800,000, and I'm going to raise that by selling 400,000 shares at $2 a share. Okay, so at that point I'm saying, hey, my company's grown over time. After this Series A round, I was $1.6 million, and now I'm double that, because the company's grown. And so I want to raise $800,000, and the pre-money valuation is $3.2 million. Does everybody keep up with that? I see some eyes kind of glazing. Sorry about that. So again, pre-money valuation means, it's a bullshit number. It means, what do I think I can sell my company for, or to raise money, right? And again, it's fictional because it's only a certain number of shares times that price. And then whatever price I'm able to get, I multiply that against all the existing shares that are already outstanding. So in this case, if I want to raise $800,000, I can raise it by selling 400,000 shares at $2 a share. My pre-money valuation, if I take this $2 and I multiply it by all of these shares outstanding already, that's how I come up with the pre-money valuation. Okay? So after I raise that money, now my company's worth $4 million, at least on paper. Okay? And so the next thing, we're going to go out and raise $750,000 at the Series C round. And the pre-money valuation, if it's $3 million, in other words, right after Series B, my company should have been worth $4 million, right? 3.2 plus $800,000 that I raised. It should have been $4 million. But guess what? Things didn't go as I had planned. Maybe my financial performance wasn't as good, or maybe the stock market is down, or maybe, you know, shit happens. Who knows? Something didn't happen that was supposed to happen, and therefore investors are only willing to invest in my company today at a lower valuation than last time. So what this means is these guys got lucky, or this guy was really stupid. But in any case, it's not good, right? You don't want to make these guys look stupid. So this is called a down round. You're going to raise money at a lower valuation than the last time you raised it. This is a really, really bad situation, and this can kill a lot of companies, right? And the reason why it can kill a lot of companies is because your previous investors are going to be pissed off, right? Like the guys that bought the common stock, they're happy. Okay, even at $3 million, they're happy because they put in $100,000, and now their stock is worth a lot more than that. But the guys who put in $800,000 at this valuation are going to look dumb, and they're not going to be happy. And because of the way preferred stock is structured, you have to vote to increase the capital of the company. You have to vote to create a new class of stock, a Series C. So they get to vote, and they're going to vote against this, unless they think they have no other choice. So how many investors are in the room? Come on, there's probably some investors. Okay, so I'm going to totally piss you guys off, sorry. So investors have two emotions, fear and greed, okay? If they're nice people, they might have other emotions, but typically, investors only have fear and greed. So fear is, if I don't agree to set up the Series C preferred and do it at a lower valuation, I'm going to lose everything. Okay? Greed is, wow, this is a hot company and they're going up. I better grab a stake now before I can't get in. Well, I can still get in. I better get in now. That's greed. So if you go and talk to investors and they're dragging their feet and they're not moving quickly and they're not throwing money at you, it's probably because of fear. Fear, they don't think you're going to do well. They think they've got time on their side or whatnot. If, on the other hand, they think, wow, you're going to raise $800,000 and you have a pick of all these different venture capitalists who are going to give you money, and I want you to take mine, I better hurry up. That's greed talking, right? They want to get in there. So those are typically the only two levers that you've got to control. Again, negotiating anti-dilution, it's a balance between fear and greed. So this is why sometimes I will trade the valuation, the greed, for the fear, and try to balance it out here, because I also have this fear concern. I have greed and fear as well, right? I want to raise as much money at the best valuation as possible, but I also don't want to get killed later on by a really difficult and draconian anti-dilution provision. So it's in everybody's best interest to negotiate something that's in between, I think, something that's balanced. Okay. So this is a kind of a diagram to show you the difference mathematically between a full ratchet provision, narrow base, and a broad base. In this sample, in this example here, where Series B we're doing a down round with Series C, right? The Series C is being done at $3 million pre-money valuation. If you remember back here, Series B invested $800,000, and the valuation, post-money valuation, was $4 million. The next round is going to be done at a pre-money valuation of $3 million, right? So they're going to suffer. They're going to get hit here. If they've negotiated anti-dilution provision, this is what's going to happen. There's going to be an adjustment to their price, and the Series B guys are going to convert to more shares, right? So if it's a full ratchet, they're going to get a big chunk of stock. And this is going to be dilution to the founders, right? Over here, when it's a broad base, there's an adjustment, but it's a relatively small adjustment, right? In this case, it's another 21,000 shares, whereas over here, it's 132,000 shares. A big difference. Okay? So this is what is meant by anti-dilution. Don't worry about the terms and all those things. Worry more about the substance. Okay? And just know that you should probably be aiming for a broad-based anti-dilution. Okay. By the way, if there are any questions, just shout out, raise your hand or whatever, and we can address questions individually. Yeah. Sorry, can you speak up?
When you negotiate a ratchet, does it cover the price in subsequent rounds?
So basically what happens is when you negotiate anti-dilution provisions, those provisions are written into the Articles of Incorporation because these are special rights that are given to the preferred. So in the example here, Series B, if they had negotiated anti-dilution provisions, those are written into the Articles of Incorporation, or at a minimum, they're in the contract. So any investor later on who's going to come in is going to be able to see that. And it's kind of like knowing how far the founders are willing to go. And so you can be sure that the next investor who comes along, it's kind of like most favored nation clauses, right? If you know that the founder is willing to give this up to the Series B, you're going to want at least the same thing in yours. So the problem is, the earlier you negotiate anti-dilution provision, and the worse it is, the worse it's going to be for the founders because it's going to cascade. All the investors after that are going to say, I want the same thing. And if all the investors after that want the same thing, the founders are really going to get screwed. It's going to get compounded. So you should be as aggressive as possible in negotiating that provision when the time comes. Mm-hmm.
Can we have these slides? Can you send a copy to us?
I'm sure somebody at Magic will take care of this. Yeah, they've got a copy of this, and I'm happy to share this. If you don't get it, email me, and I'll send it to you. Okay. It's at the end of the deck, at the very end. I'll put that up. Okay? And if there are any investors here who think I'm full of shit, just let me know. I'm on both sides. You know, I invest sometimes, and but I spend most of my time on the entrepreneurial side. So, as you can see, I'm quite biased. Okay, investor redemption rights. Again, the first two things I talked about are the most important. So, in terms of order of magnitude or priority, this is much less important. Typically, this is a right. And it could be an obligation as well, but it's usually, if enough time has passed, from the investor's viewpoint, I want my money back, or from the startup's viewpoint, give me back all the special rights that you have. Okay. Practically speaking, the entrepreneur is going to be hard put to actually exercise this right and force the preferred to convert, because usually they can try to get them to convert all the preferred to common, but it's hard to buy it back because they don't have the cash. Okay, so it's rare to be able to do that. On the other hand, if you're the preferred investor and the investment's going sideways, the worst case is you have these living dead companies and the management is making enough money to pay themselves more money, but the investors are never going to see an exit. In this case, if you're an investor, you want to exit. Typically, a venture capital fund is 10 years long, and they've got other people's money. So usually it's pension money or some family office or whatnot, and they have to return that money after 10 years. So if they don't get you to sell the company or to go public, they have no exit. So what they'll do often is they'll try to negotiate in the redemption rights, and that just is a way for them to try to get an exit. And typically, this doesn't give them the right exit because the company's not in a position to do it. But what often happens is this is kind of the hook that they have to put pressure on the founders to try to get them out, to maybe find somebody else to buy them off or whatnot so that they can get their exit. Same thing, conversion right. This is like to convert it from preferred to common. Again, if you're the entrepreneur, remember the preferred has all kinds of special rights. So what you want to do is get them into common as quickly as possible. Even simple things like voting at shareholder meetings. With preferred stock, you have to have several different votes. It's just more paperwork, it's more headache. And really what you want to do is just convert them all over to common and just deal with everybody the same. But of course, people with special rights want to keep those special rights. So it's kind of a tug of war, and you have to negotiate this. Typically, the investor can convert at any time that they want to. And for example, a lot of preferred rounds are syndicated, right? There's more than one investor. So if 80% of the investors want to convert, they can usually force the other guys to convert as well at the same time. Voting rights, I think most of you have seen the movie Facebook. This is one thing where they set up the company with special voting rights. I think Google's the same way. The founders have very strong voting rights, special voting rights. That's not typical. Typically, what happens is preferred holders, common holders usually have 1 vote per share. And typically, the preferred holders have 1 vote per common on a converted basis. That means if you've got 800,000 shares of preferred and it converts into 800,000 shares of common, you have 800,000 votes worth of common. That's typical. Also, in terms of corporate governance, and again, this is really kind of boring, arcane stuff, but in the old days, we had this thing called classified boards. That meant that the board was divided up, and you usually had representation on the board if you were an investor. By the way, do you know what observer rights is? We'll talk about this a little bit later. Oftentimes, investors will have observer rights. That means they get to show up at board meetings and sit in on board meetings. I strongly recommend against this. Anytime somebody sits in on a board meeting, it changes the dynamics of the board meeting. So either you're a board member or you're not. And if you're not, don't be there. That's my advice. Don't allow observers in the room. But classified boards means, for example, in the old days, or even today, a lot of times you want to have a classified board because it's protection against the takeover, hostile takeover. And for private companies, it's not that big a deal. But for public companies, it's a big deal. And so oftentimes, it's like saying that, change of government, we're going to divide up the board into 3 different sections. and every year only 1/3 of them are up for re-election, so that somebody can't come in and take over the board all at once. With startup companies, you have this to a certain degree because oftentimes a preferred series is granted 1 board seat or 2 board seats. And so they may control the vote for that board member. And it can be quite a headache logistically. You have extra board meetings, extra minutes, extra meetings. It's actually quite tedious. Let me talk a little bit about restrictions. So the 2 main ones I want to talk about was automatic conversion and company redemption rights. We've already touched on this a bit. Typically, an automatic conversion happens, at the earliest 3 years after the investment, and typically it's got to be at 3 to 5 times the valuation or the investment amount. This is often true for IPO. So in the articles, you'll have written in that upon an IPO, that is going to be, an increase in value for you of at least 3 to 5 times what you've invested, that you have to convert, right? And this is to drag them along and force them to convert. And again, 80% of the investors can typically force the remaining investors to follow along, whether they want to or not. And this is important because if you have any stragglers, that class of stock, that series of stock will remain, right? So if you have 3 Series A preferred investors and 2 of them want to convert, but 1 doesn't, you don't want to maintain that Series A just for that 1 guy who didn't want to convert. You want to convert everybody over. So there's usually a provision in there that says if 80% of them agree to it, then everybody has to convert. And then company redemption rate, as we mentioned earlier, is typically difficult to actually do. This is where the company can force you to redeem. Depending on the country you're in and as well, this may not be practical because, for example, in Japan, we have rules against impairing capital. So if the company has burned through a lot of the capital, even if they had a contractual right to buy back stock or to force you to convert, legally they're not allowed to do that. So this is a negotiated term, but it's much less important. Okay, contractual rights. Again, sorry, for some reason I was given the most boring topic to talk about here, but we talked about classified boards already. In the old days, because of takeovers and whatnot, this was very common, but nowadays there's a trend away from having a classified board. So you just have everybody kind of on the same type. Elections are once a year or once every 2 years, and the entire board's up for re-election at that time. Voting agreements are very common to have, especially for the later rounds of financing. So in addition to having a stock purchase agreement and having the special rights as a preferred stock investor, you often will negotiate with the other shareholders to have special rights by contract. So in other words, everybody agrees to do a certain thing based on a contract. And you have this on the side. Again, observer rights, I typically will negotiate this out. I don't want anybody on my board or sitting in the boardroom when we're talking about things that is not a director. And this is, to me, this is really important. As a founder and usually the CEO of the company, I really don't want somebody in the room who's not on the board of directors. It changes the dynamics of the discussion. And typically, if you can think about it this way, one of the hardest discussions to have is going to be selling the company, right? And having an observer in the room when you're talking about whether to sell the company or not, what happens is the directors who have to vote are going to vote differently, or they're going to act differently because somebody's watching, right? It's kind of like, if you're a guy, right, and there's a pretty girl in the room, you're going to act differently than if it's only guys in the room, right? And what happens is it really kind of screws you up because these are all directors, so they have legal obligations. But if you're trying to get your board to go in a certain direction, this is going to make it much more difficult to do that. And so I strongly recommend against letting any observers in the room. Typically at an IPO, everybody gets wiped out and everything converts to common because the public markets don't like complex capital structures. Right? They don't like certain investors to have special rights over other investors. So in an IPO, typically everything converts over and you have only common shareholders. Maintaining ownership. A lot of times I'll try to do this when I negotiate preferred agreements, when I do venture financings. I try to negotiate that certain rights that the investor has, they only have as long as they own a certain percentage of the company. So what that means is that in subsequent rounds of financing, as I'm trying to grow the company and raise more capital, if those investors who came in early don't come in on the next rounds and they get diluted down, that they stand the risk of losing their preferred rights. So I try to negotiate that in. Let's see. Rights of first refusal. Again, this is a right. It's not an obligation. So as a founder, you should be very aware of this. You're giving basically an option to the investors that if they like it, they can invest in, but they don't have to. And you have to take any discussion to them first. In follow-on offerings, when you're trying to raise money for your company, it's a nightmare. It's a lot of work. And talking with, like, if it's only one investor who's going to invest in the whole round, it's not as bad. But if you're talking to 10 different investors who are going to potentially invest in your company, it's like herding cats, right? You get 3 to agree to yes, and then while you're chasing the fourth one, the first one disappears, and then you get the fourth one, and then now you're back at 3, and it's a logistical nightmare. So if somebody has preemptive rights, it just makes that all the more complex, more complicated, more difficult to actually happen. So you want to negotiate this aggressively and sparingly. Oftentimes, there'll be times when you actually, like you try to exclude some of these things, like normal day-to-day stuff. As a CEO, you don't want to lose control over those issues. So you'll try to exempt those, exclude them from any transaction, like hiring on a new employee or a consultant. You don't want to have to get approval for every single thing that you're doing. Information rights. I'm usually quite generous with this one because it's one of the easier things to give up. It means that when I'm running the company, I try to keep things as visible as possible. I try to make sure that my accounting is timely and accurate. And I'm usually not hesitant to share that with my investors. It also is easier because if I can just send over the financial reports to my investors, then I don't have to sit there and explain all kinds of other things to them. Again, I don't want them to be in the board meeting as observers, but I'm happy to send them our financial reports on a regular basis. The other thing I've noticed with a lot of early-stage startup companies, usually the books are a mess. It's hard to hire an accountant from the get-go, but what you really do want to do is you want to set up the processes in the beginning when you're starting your company. You want to make sure you have somebody who understands that, and they help you set up the books. Once they set it up, it should be pretty easy to just run on a monthly basis. It's that initial step that's important. The worst companies I've seen are the ones where they just, kind of wing it. They make it up as they go. And then at some point in time, somebody has to come in and do a major cleanup job. And the reason why this is bad is because 2 things. One, it's expensive to clean it up. Sometimes you can't even clean it up, even if you try. And usually, when you raise money from investors or when you sell the company, there's a discount. If your books are a mess, investors are worried about risk and what they don't know. And so they're going to give you a discount. They're going to cut down the price that they would have otherwise given you. And I hate to sell my company cheaply just because my books are a mess. So I always make sure that they're set up properly from the beginning. Reg rights, again, sorry, this is a very US-centric explanation. An S1 refers to the type of filing that's done when companies go public, the IPO. An S3 is typically a follow-on offering. All this means is that sometimes your investors have the right to demand that you go public, right? If things are going well, but you still don't want to go public, your investors may have the right to push you to go public. And like I said earlier, financial investors are in it to make money. And typically the way they've raised money is through a partnership agreement, limited partnership, general partnership. And it's usually a 10-year life on their fund. So they have to return money to their investors in 10 years. So if you just are doing well and you just keep pooling the money, but they don't get to sell, it's not good for them. So they typically negotiate this right in there as a contract. And as a matter of contract, they can force you to go public. It's usually 3 to 5 years after they've made their investment. Lockup after IPO, as the founder of the company, as management, you want to negotiate this into the agreements. Don't forget this. And the reason why this is important is because when you go public, your underwriters don't want all of the shareholders to sell on the first day, right? If you're going public and all your investors are not locked up, in other words, they can sell whenever they please, then a lot of them may try to sell on the day of the IPO. And as you know, supply and demand, if there's a lot of people trying to sell on the day the company goes public, it's going to kill the stock price, right? So you want to make sure that there's an orderly liquidation of the position. You want to make sure that whatever position they have in your company, whatever stock they own, that they sell it on an orderly basis so that it doesn't screw up the markets. And your underwriter wants that as well. So your underwriter will basically demand lockup rights. They'll demand that the existing shareholders agree to not sell any of the stock for 180 days. If you have not negotiated this provision in advance and you're planning to go public now, it's really difficult to get your investors to agree to this now. It's very easy to get them to agree to it at the time they put their money in. So don't forget to negotiate it up front. And by the way, if your offering is really hot, like if it's a really popular stock offering, the underwriters will probably allow the shareholders to sell stock before 180 days. But again, it's an obligation on the part of the shareholders not to sell for 180 days unless the underwriters give them permission to do so earlier. I think probably the last topic I wanted to raise, how many of you have co-founders? Okay, looks like maybe a third. Do you have a buy-sell agreement, or do you even know what a buy-sell agreement is? Okay. Does anybody have a buy-sell agreement? Okay. Does anybody have repurchase rights on stock? Nope. Okay. So I live in Japan, and it's not usual. It's very unusual to have repurchase rights or buy-sell agreements. I think that's a mistake. In Silicon Valley, we have this. It's very common. I think of it as a best practice. There are a lot of things that are US-centric, which I would recommend against. But buy-sell agreements and especially repurchase agreements for co-founders, I strongly encourage. Let me just jump ahead to a slide. This is a reverse vesting on stock, basically co-founder stock. So everybody knows what stock options are, right? Stock options, you work at a company, the longer you work there, the more rights you get to buy stock at a cheap price. Typically, with stock options, it's 4-year vesting, and none of it vests the first year. But after the first year, you get 1 year's worth of stock, and every month after that, for the next 3 years, you get 1/48th of the stock. So if you get a stock grant for 48 shares, it means that for the first 12 months, you get nothing. But after 1 year, you get 12, options for 12 shares. And then every month after that, you get options for 1 more share. Okay? That's typical vesting for stock options. Reverse vesting is the opposite. So for example, if I was a co-founder, okay, let's say I start a company with 1 other person, and I have 100 shares. Okay, what that means is I bought my shares subject to repurchase rights. So I actually own the shares, right? I can vote them, I own them. But there's one caveat, and that is if I leave the company before 4 years, the company has the right to buy back some or all of the shares that I have at the original price. Okay? So imagine, going back to the first example, we were selling shares for 10 cents a share, but the investors were coming in for $1 a share after that, right? So what this means is if I had 100 shares and I leave the company after 1 year, that the company can buy back 75% of the shares, so 75 shares, at the original price of 10 cents per share. Right, so this creates a big incentive for me to stay there and work hard. The reason why this is important is because, let's say I started the company with a co-founder, okay? And I'm the CEO, and my co-founder is the CTO, right? And the reason why they're getting a big chunk of stock up front is because they're supposed to help me build the company and turn this into a lot of value. If they leave after 1 year, their job's not finished yet, right? So if my CTO walks out the door after 1 year and he has 30% of the company, and he just disappears with 30% of the company, that's really bad. It's bad for me, it's bad for the other investors. So what I want to do in that case, I want to buy back those shares when he leaves, and I want to be able to issue those shares again, recycle them, and issue them to the next person I find who's going to replace him and do the job that he was supposed to do. If I don't have this set up ahead of time, when he walks out the door with 30% of the company, it's gone. And then I have to sell new shares to the next guy who comes along. It means everyone else is going to get diluted down. This is really bad for morale, especially for the founders. You feel like you're getting screwed twice. Once because the guy left, and you got to do all the extra work. And then in order to get somebody else to come in the door, you got diluted further. And he gets to keep his shares, and he's not doing anything, right? So I strongly recommend you put in place repurchase rights. You make sure that your co-founders, and this is not for other employees, this is for co-founders. Any co-founder that joins a company and gets cheap stock, that if they leave before 4 years is up, the company has a right to buy back their shares. And this is the formula for how they do it. Okay. A buy-sell agreement is much more straightforward. If there's 2 founders or 3 founders or whatever, it means whoever's leaving has to sell the shares back to the people who are staying. And it's a right that the people who are staying have. So if they don't have any cash, they don't have to buy it back, but they have the right to buy it back. Okay? It's typically at a low price, oftentimes at the original price. That means that even if the company has appreciated in value, you can still buy it cheap. Other times, the price may be market price. It might be set at market price. And that means, for example, if 2 people start a company, and 10 years later, the company is successful, but one of them wants to go do something else, you'd have to buy back those shares from them, and you'd have to figure out what the current market value is for that chunk of stock. different incentives behind the mechanism, and that's why you may want to have both. You may want to have these repurchase rights set up so that if anyone leaves before 4 years, the company can buy back the shares. But vis-a-vis another co-founder, you might want to have an agreement that is longer than 4 years. It may actually be unlimited. And that basically, if you ever get divorced or if you ever leave or whatnot, that the person who's going to stay behind and run the company has control over the company, over equity. But in return, they have to pay fair market value for that. So it's a kind of a two-way street, and you just want to make sure that you're trying to ensure the stability and the future of the company. So I strongly recommend that you have both of those things in place. And I know that it's not common to do in most parts of Asia, but I think it should be, and I strongly recommend adopting this practice. And then the last thing is just co-sale rights. So that just means like if the founders are going to sell their stock, that the other investors get to piggyback on that. They get to sell stock at the same time. And it's usually, it can be negotiated. It could be in relationship to whatever percentage they own of the company. So if they own 50% of the company and you want to sell some stock to a third party, that half of the shares they get to sell, and you get to sell half of the shares. Or it could be that they get to do all of that up front. It's negotiated. Again, this is one of the lesser things, though, because typically founders won't sell out their shares all by themselves. Usually it's a sale of the whole company. But it's one more thing to negotiate. But it's a much smaller issue. And I think that's it. So this is my email address. If you don't get the slides and you want them, just email me and I'll send you a copy. Thanks for your attention. So I think I'm early, right? So any questions? Thanks. Sorry, get a mic.
The mic. Hello. Just now you mentioned about the co-founder buyback agreement.
Yeah.
Okay, let's say if we have done the agreement, then the co-founder is not contributing. So I mean, like he or she just sit in the office, do nothing. So how should we like kick him off or anything?
Yeah, it's very common. It happens all the time. But remember, they may be saying the same thing about you. It really depends. But typically, the rest of the team knows who's slacking off and who's working. Typically, when I draft the repurchase rights, so let me see. I prefer the benevolent dictator model. In Japan, we have a restriction that the company is not allowed to repurchase shares if it has a negative net worth. So oftentimes, startup companies burn their capital and have a negative net worth. And so legally, they would not be able to buy back the shares. So one way I short-circuit that provision is I typically subscribe to all of the shares first. So for example, if you and I are going to start a company, and you're going to be the CTO, and I'm the CEO, and I'm going to give you 30% of the company, I would buy 100 shares first, and then I would sell you 30 of those shares. And I sell that to you at the same price, but under the contract between you and me, I say that if you leave before 4 years, I can buy back the shares. And when I say that, I say if you leave for any reason. In other words, if you leave voluntarily, or if I fire you, or for any reason, I can buy back the shares at the original price. And that's the model that I usually use in order to get around the legal provisions in Japan. I don't know what the rules are in your country for that, but my guess is if you did it in a similar way, it would probably be okay.
I got a number of questions. Number one is that I don't fully understand the slides.
Me neither.
Recommend me any like reading materials for me to better understand your slides?
Yeah. For each slide, I've put a title on the slide. If you Google the title of the slide, you definitely will be able to pull up all kinds of material, background material, definitions, explanations about it. You should have an easy time finding more information on each topic.
Where can we get samples or examples of term sheets and also the buyer-seller agreements, which are a really good one?
Okay. Term sheets, what I would recommend you take a look at, and there's a Series Seed agreements that were created, there's the templates that were created in Silicon Valley. You know, in the old days, for example, when I was a lawyer, this was all like hidden. The advantage was always with the venture capitalists because venture capitalists, you know, had the knowledge and the entrepreneurs didn't. But nowadays, everything is disclosed. It's all online. In fact, it's so much so that a bunch of lawyers have gotten together and prepared some model agreements. If you type in Series Seed, S-E-E-D, agreements, you will find a website that has samples that you can download in Word format and use. And you need to modify these for your country. But the general provisions that are contained in those agreements are really good, I think. They're much fairer. So again, you know, when I was a lawyer, I was in Silicon Valley, and we used to always joke that the lawyers in New York and the lawyers in Silicon Valley were different because in Silicon Valley we had so much work all the time that whenever we negotiated, we start like close to the middle and we negotiate to the middle. And New York lawyers would like negotiate out here, and so you waste all this time to get to the middle. But I think the Series Seed investment agreements are very much kind of the middle to start with. So I would recommend you take a look at those to start off with. There are other templates online as well, but I prefer the Series Seed investor agreements to look at. One kind of different question or different answer to a slightly different question. Right now, or for the last couple years, convertible notes, how many of you you've heard of convertible notes, seems to be the rage. I hate convertible notes. I think they're bullshit, especially for Asia. But I see a lot of venture capitalists in Asia blindly following that pattern. Convertible notes basically means in order to get the deal done quickly, the initial negotiation is structured as debt. So it's like, I lend you the money, and then at some point in the future, that will convert into equity. And the reason it was done in the States was because of speed. Like I said earlier, it's hard to line up a whole bunch of different investors at the same time. Whereas a note, you might be able to get $50,000 here, $200,000 here, $100,000 there, and then later on you convert everybody to equity at the same time. So it has that benefit, but the drawback is that on your balance sheet, it's debt. And debt, if the lender says, give me back my money, you don't have it. Right? I mean, a startup company, you're burning that money right away. As soon as it comes in, you're using it. So if the lenders ever said, you know what, I don't want to convert to equity, just give me back my money, you're screwed. So I don't like convertible notes. Very recently, within the last 12 months, there's been a move towards convertible equity in order to take care of that problem. That's slightly better, but again, in my experience, most financing rounds that are done in Asia are done so slowly, it takes so much time to do them anyway, that the benefit, the so-called benefit of doing convertible notes or convertible equity is negligible. So that's the reason why I didn't put it in my presentation today. I thought it was much more important that you understand the fundamentals of the main points to negotiate for any transaction rather than whatever the latest fad is in financing.
And also, can we get your service? How much you charge?
I stopped being a lawyer many years ago. Yeah, you don't want me as your lawyer. I could probably give you a referral to somebody in your country who might be able to do a better job.
Can we send you an email? You review it for a price.
I'm happy to help out. If you send me an email and I have the bandwidth, I have the time, I'll take a look at it and maybe give you some business advice. But again, you get what you pay for, so I'd probably just give it to you for free. Okay.
Thanks.
Yeah.
Hi, Jeff. I've just got a question. How would you handle a situation where a competitor is looking to acquire you and they're putting out feelers and saying, look, we want to buy, or let's look at a potential acquisition, but nothing is inked yet. So you've got to open the books, open up commercially sensitive information. How would you handle this situation? Or what's the best way?
Okay. Oftentimes, a potential buyer is a competitor, right? Because it makes sense for them to take you out. The problem is, though, that if you show them, like if you show them financial information or technical information, it's kind of like, you know, the US criminal code. Anything you say can and will be used against you, right? So if you show them, especially intellectual property, they may use that against you in the future. They may say, okay, guess what? We're not going to buy you, and instead we're just going to destroy you in the marketplace. That would be bad, of course. So oftentimes what I'll do is negotiate with assumptions. So typically they come in and they do diligence, right? Due diligence check to make sure that everything is the way it's supposed to be. And what I'll do is I'll negotiate the terms of the acquisition in advance based on all of the due diligence turning out the way it's supposed to be. But I'm very clear on what the objectives are, and so try to make the objectives very clear so that they can't back out of a deal. Okay? So let me go back to even more fundamental things. In M&A, whoever says the price first loses, right? If you're the seller and you say a price, I guarantee you it will never be more than that. And if you're the buyer and you say a price, it will never be lower than that. So whoever says the price first loses. And typically, in most negotiations, the seller has the momentum or the home advantage up until the time where you agree to sell. And then it shifts. Then the buyer has the momentum. So the right answer when a potential buyer is coming and talking to you, the right answer typically is, I'm not interested in selling. I'm not thinking about selling yet. What you want to happen as a seller is you want a transaction to go down quickly and efficiently. Again, once you agree to sell, you want to make sure that any milestones or any potential speed bumps are limited and very objective. You don't want to give the buyer a lot of discretion on how long it takes for them to do diligence or the reasons why they could back out. So you want to limit their exits once you negotiate an acquisition. I really can't stress how important that is. You will really regret, if you're a seller, you will really regret agreeing to sell the company without having those things in place. And again, if you talk to somebody who does this often, you get the wisdom of their experience, and that's really key. So talking to the right lawyer who spends a lot of time doing those kinds of transactions is important. Don't worry so much about what they cost per hour, but find the right person who has that experience. Again, one company that I sold, better not disclose names. So one of the companies that I've co-founded, we were approached by a competitor that wanted to acquire us. And the main reason they wanted to acquire us was because we were providing a lot of competition in the marketplace for them. And our cost of delivering the service was less than half of their cost. So when we get into pricing wars, if we lower our price, we could actually cause them to lose money because their cost was so much higher to do it. So we just had to offer a price which is above our cost but below their cost, and it will cause them to lose money. So they had a huge incentive to acquire us, and in fact, they acquired us for a big premium over the value of our company. And the main reason they did that was to avoid a pricing war. The first time we talked to them, they really dragged their feet, and they were taking up a lot of our time. And we're a tiny startup company, and so it really was a distraction. So after 1 month, we just told them to piss off and to go away. And about a year later, they approached us again. And this time, we weren't ready to sell, so we told them, never mind. But a year after that, my co-founder decided he wanted to sell. So we actually approached them, and we said, we're ready to sell if the price is right. You have 1 week to do due diligence. And we prepared everything ahead of time, and we put it in a separate room. But we said, you can only do due diligence if you provide us with a binding letter of intent, and the price is in the letter of intent, and all the conditions are in the letter of intent. And we also said that the contract, the definitive agreement, has to be negotiated and completed within 2 weeks after due diligence. So we called the shots on the timing. And again, this is a unique situation because we were in a position where we could dictate terms, and we could dictate terms for 2 reasons. One was because we actually started talking to one of the other foreign competitors, and if they came into the market, they would have really dropped prices and there would have been a pricing war. So the pressure was on this potential buyer to buy us. And the second reason was because we had a track record for telling them to piss off. So when we went to them and said, we're willing to sell, but you have to do it in this time frame, they jumped at it. And we actually were able to negotiate a really good acquisition price. But timing is really important, and not leaving them with a whole bunch of options to screw around with you and to delay things, and then to, after they finish due diligence, say thanks but no thanks.
This binding letter of intent, it's enforceable by law, I assume. Now, when you made them sign that binding letter of intent, did you put the price in there? Did you have like a ballpark figure in mind, or a firm price, which you say, or do you leave it to them?
Yeah.
Because the enforceability of all these letters of intent are, to my knowledge, not there.
Okay, so there's in contracts, there's binding and non-binding. Same thing with term sheets. Typically, with a venture financing term sheet, the only thing that's binding is the no-shop provision, so don't go talk to other people during a certain period of time. Everything else is typically just indication, it's not binding. In the case of our M&A deal, the letter of intent, we negotiated it to be binding. So we actually said, this is the price that we're willing to sell at. And if you're not willing to buy it at that price, then you may not then we're not even talking. So they had to agree to that price to begin with. But it's negotiated. It's always negotiated.
Hi, Jeff. I got 2 questions. Mm-hmm. First is, do you have any advice, or is there an unwritten rule on how much equity you should share with your co-founder, be it maybe if a CTO or you have maybe 3 co-founders? Is there a guide that we can look for?
Yeah.
Yeah, I'll ask you my second question after this.
Okay. Equity is near and dear. You should be very stingy with equity. The worst thing I see is when I see like 4 or 5 kids coming out of college, starting a company together, and they divide up the equity 20% to each of the 5 people. That's a really dumb way to do it, in my opinion. And the reason is that reality is that all 5 are not going to do the same amount of work and not the same amount of commitment to the venture. It could happen, but I've never seen that happen. More likely, one or two people are going to be primarily running the company, and the other people are just going to be cheerleaders. So equity should reflect that. Also, it's easier to have one person kind of be the CEO. And there are few high-profile companies that have co-CEOs, but I think in general that's a bad decision, and I recommend against it. So I really think it's best to have one CEO who has a dominant position in equity, who, if push comes to shove, can call the shots and make the decisions. And I think sometimes even the wrong decision is oftentimes better than no decision. So I don't like socialist capital. I don't like having everybody have the same amount of equity. I think the founder, the primary person responsible for the company and the success of the company going forward, and again, it's not just whose idea was it. It's really who's going to drive this home and make it successful. That person should have the lion's share of the equity. In terms of the actual numbers, I don't know. It really depends. Because, for example, one of the key players might be married, and have a husband and require at least a minimum salary. And one of the other people might say, I have a little bit of money, I'm single, I'll eat ramen, and I don't need any salary for the first year. So you have to put all of those factors together to decide what's fair. But really, it should reflect the team going forward and what's fair.
Thanks. My second question would be, earlier you mentioned that try to delay raising money because you lose control of your company. So do you have any advice on how do we gauge when the company is ready to raise their first maybe seed or Series A funding? When is a good gauge, or any indicators for that? Thanks.
Okay. Typically, and again, this is not scientific, it's just like kind of wet finger in the air. Every time you do a round of fundraising, you give up about 20 to 30% of your equity, or you have dilution, okay? So you don't want to do it too many times. In terms of when are you ready, my personal opinion is, in terms of the company's life, I think of kind of like before you find the product market fit, and then scaling as kind of a differentiation in time. To me, that's like, BC and AD. And I think when you're in the search mode, when you're trying to figure out what the hell you're doing, and you're making lots of mistakes, that it is better to be using your that when you're still in that search mode and trying to figure out what you're doing, it's better to be using your own money and really kind of feeling the pressure of trying to hold the team together with a story and no money. And you get much more creative. It's easier to ask friends for favors. It's easier to ask your employees for favors. It's easier to ask their family for favors when you have no money. And it's easier to figure out the right mechanism to scale your business when you have no money. Because, again, especially like internet businesses, I think internet, mobile businesses, one of the, like my first company, the first $250,000 we spent just to buy the server and the database. 1997, it cost a lot of money just to buy the hardware and software, just to set up. Whereas now, you $10 and you can set it up on AWS, right? So it's really different. So just being forced to use your own money in the beginning is a lot easier now. The hard thing now is standing out. It's getting traction, right? Because before, it was so hard to get there that most of the other weaker competitors got killed beforehand. They couldn't even raise the money, right? But now, anybody can get up and running. So the hard thing is standing out. right? The hard thing now is marketing and getting users, getting traction. And that's become much more competitive. So if you're spending money on SEM, you're going to lose. I should be careful. I started an SEM company, so we got paid a lot of money. But if you're spending a lot of money on SEM, that is not a good use of money. Unless you can prove that for every dollar you spend, you're getting much more in return. But by and large, most startup companies can't prove that. They just are throwing money at SEM just for the hell of it because they don't know what else to do. If you have no money to throw at SEM, it's a good thing. It forces you to become more creative. And I think the best internet and mobile startups are the ones that can figure out how to get customers to bring in other customers without spending money. That is what will make you successful. That is what will make your business wildly profitable. And it's hard to do that when you're sitting on top of $10 million or even $2 million. It's a lot easier to figure that out when you have $10 left in the bank, right? So I strongly recommend that you not raise money when you're in that search phase. But once you've figured out what the heck you're doing and you've figured out that mechanism for scaling up, that's a good time to raise money. And it's also, think about it, it's a lot easier to sell it, right? You know, it's like the old story about raising money from the bank, right? When can you raise money from the bank? When you can prove to the banker that you don't need his money, right? And when you need the money, he won't give it to you. So with investors, it's similar in the sense that if you go to them and say, I don't know what the hell I'm doing, but please give me $1 million to keep me alive so I can hire these 5 people who are smarter than me to help me figure out what I'm doing, not a good story, right? If you go to them and, like what Kylie was saying earlier this morning, and I got this traction, I got done all these things without raising money yet, so just imagine what I'm going to do when I have some money. Much more willing to throw money at you. So I think if you're in that search phase, that you haven't figured out your business model yet, and you haven't gotten any traction yet, don't raise money. Don't even try to raise money. It's just a waste of time. But if you are in that phase where you've already figured out and you want to scale, that's the best time to raise money. And the one extra thing I'd like to say here, because this is Asia, in Silicon Valley, oftentimes, even before we have traction, we have to go out and raise a lot of money because all of our competitors have also done that already. It's an arms race. But this is not Silicon Valley. So you don't have that pressure to run out and raise a lot of money. And in fact, if they want to raise a lot of money in Silicon Valley and then come running over here to Malaysia or Singapore or wherever, they're just going to burn it because they don't know the market here, right? The market dynamics are very different here than they are in Silicon Valley. So the fact that they raised a truckload of cash in Silicon Valley should be meaningless to you. If anything, it means that they've already given up a big chunk of control in their company. You haven't. So again, I don't know your market in particular, but for example, in Japan, if I compare a company called Gree, which is a game company, against, say, Zynga, right? Before Zynga went public, they raised almost $1 billion in venture capital. $1 billion, right? And Zynga, did this, and they got to market, and they got this high market value. Gree was much more profitable. They raised how much money, do you think? Compared to $1 billion that Zynga raised. Gree raised $5 million before they went public. 5. Guess which founder has more equity in his own company? Yeah. So, this is not Silicon Valley. I don't think you have to play by Silicon Valley rules. I think there are best practices that you can learn from, that you can adapt to your own market, that that make sense. But I don't think it makes sense to blindly follow these things. So when I start a company in Silicon Valley versus starting one in Japan, I do it very differently because they're different markets and different times as well. So sorry, that's a really long answer to your question, but it's don't raise money before you've figured out what the heck you're doing.
Hi. Oh, yeah. I have a question regarding the repurchase agreement and valuation.
Yep.
Just now you mentioned that when you have a repurchase agreement, oftentimes, startups will be burning cash. You put in, like, let's say, like 100,000 capital, you'll be worth less than, like about a year or so. And if the other party, the other co-founder decides to leave by then, like you have the repurchase agreement, what would be, like the price to pay to buy back the shares? I mean, like, how would you value the company by then? Because you guys are, still not making money. And you have like zero cash balance in your bank.
Yeah.
And yeah.
Okay, so again, it depends on whether you're talking about buy-sell agreement or repurchase agreement. They're very different and different purposes. Buy-sell agreement is typically what happens if there's a divorce. Okay, that the founders break up. The repurchase agreement is usually what happens if one of the founders leaves early, prematurely. So in the case of the buy-sell agreement, usually the purchase price, the repurchase price, is fair market value. Okay? And in that case, you have a problem. But in your example, the company's not worth much. So it should be a low price. It may very well be less than you invested because the company has not grown and hasn't done well. On the other hand, if the company has done well, I might go out and borrow money in order to buy you out. In the case of the repurchase agreement, because you're leaving after only 1 year or after 6 months or whatever, typically the repurchase price is going to be the same price that you paid for your stock. It's the original purchase price. And typically your stock was very cheap, right? You bought cheap stock. So it's not a big burden on me to buy it from you.
Okay, all right, thanks.
Yeah.
Hi, Jeff.
Hi.
As an entrepreneur, what do you think is your preferred fundraising method? Angel investors, VCs, or crowdfunding?
Okay. Depends on what you're doing, I think. The same way you want to match the source of capital to the use of capital. So for example, if you're going to build a factory, right, you don't want to do that with short-term debt. You want to do that with long-term debt or with equity. The same way, if you're trying to build a company and let's say you're doing something that's internet-based and it's B2C, crowdsourcing might actually be good for you because it might increase your exposure, right, and get you more customers or more users. On the other hand, crowdsourcing is messy, right? It's closer to dumb money. That doesn't mean VCs are all smart. It's just, typically they have more at stake, right? Rather than having 1,000 people with $1 each invested versus having one guy with $1,000 invested, the one guy with 1,000 is probably going to be more involved because they have more at stake. And the people with only $1 at stake will probably just forget about it. It's not a big deal for them, right? So if you're just talking about raising money and money is fungible and you just need a certain amount for now, then any of those are possible. But if you're going to grow a company over time and you need more rounds of capital later on, raising it from a venture capitalist may be a better alternative. But again, it also depends on timing. So if you're really early stage, you may not want to do it from a venture capitalist yet. In fact, they may not even pay attention to you yet. But in that case, maybe crowdfunding is a good alternative, or angel is a good alternative. Typically, when I'm trying to take money from somebody else, I want to get more than just the money. So if it's crowdfunding, I want to get users, right, or customers. If it's angels, I want to get advisors. I want to get introductions. And venture capital, then I definitely expect introductions. In fact, maybe even looking at their portfolio companies and saying, you've also invested in these 3 other companies, and those are 3 companies that I would love to do a deal with, and I need an introduction to them. In fact, I need more than an introduction. I want you to twist their arm and get them to talk to me. And that might be the right venture capitalist for you. So it really depends on what you're trying to do with it. But pragmatically speaking, as an entrepreneur sometimes, you're like, hell, I just need this money. I'll take it from anybody, right? And there are those days. Ideally, though, you're raising money from a position of strength. and you can actually choose. So it makes sense to have as many options open as possible. And then when you have those options, then you can make that decision.
Just another really silly question, but do people raise money through bonds? I mean, bonds is really, really long term, right?
So bonds, basically it's debt, right? Bond is an IOU. It means I have to return the money at some point in time. The reason why a lot of tech startups should raise only equity is because we don't have the track record and the stability to pay back debt on time. Typically, when you borrow money from a bank or on a bond, you have to pay it back on a fixed schedule. Okay? But we don't know how much money we're going to make tomorrow. We don't know if we're going to make money tomorrow. So agreeing in advance to pay back money on a fixed time schedule is very risky. And also, with equity, if you cannot pay it back, you say sorry. Right? With debt, sorry doesn't cut it. Right? You'll bankrupt. So given the choice, again, I'm often willing to trade the valuation, like a slightly lower valuation, or giving away some of the upside, sharing the upside with other people in order to take away or to minimize risk. That's why I typically avoid debt. A bond or bank borrowing is a good way to supplement capital when you already have a stable revenue stream. Right? So if I'm already operating, I'm already doing business, and I already have certain revenue that I can count on, then borrowing an amount that equals the repayment of that with my cash flow might make sense, because I don't have to share the upside with the investor. I just have to pay them back. But I think for early stage startup companies, debt is very risky. Okay, so I think that's it. Yeah. One last question. Okay, one last question.
Any thoughts on strategics, and what's the most ideal situation for a strategic investment?
Are you a strategic investor?
The other way around.
Okay. Strategics can be good, but they can also be a nightmare. So it really depends on whether your goals are aligned or not. You have to understand what the incentive is for them to be investing. That's typically the case with most corporate venture capital. If the corporate venture capitalist, the goal is a financial return only, then it's easier to understand them. If, however, their agenda is to generate more business for the parent company, then you also should understand that as well. So it really depends on what you're looking for and whether your goals are aligned or not with them. If your goals are aligned and you think that they will stay aligned, then corporate venture capital or a strategic investment might be excellent. It might be the best thing you could do. It also gives a venture capitalist more comfort, because supposedly the strategic investor knows what they're doing. You're operating in an area that they're interested in, and so it provides some validation from a marketing or technical risk viewpoint. But you really need to be careful to understand that your goals are in alignment and that they will stay in alignment. I've seen many corporate investments, so-called strategic investments, turn into, best case scenario is it works out. Typical is it's just money, and usually nothing works out after that. They just put in the money and then they're gone. And the worst case is they actually screw you up. They actually either try to do what you're already doing, they compete against you, because even if they invest, there's no restriction on them typically, for doing something that's competitive. And so they watch what you're doing and then they launch something that's competitive. That's really bad. Or they just use it as a cheap way to acquire you. So you really need to be aware of why they're doing this. Okay. I think we're done. Thanks a lot for staying awake.